Good morning. Welcome to RM2's latest webinar on how are employee ownership trusts being used in practice. My name is Nigel Mason. I'm one of the directors of RM2, and it's my pleasure to present to you this morning. We're going to take up to 30 minutes to describe to you the current state of the employee ownership trust market, and in particular to look at the results of a survey that we have recently conducted on how EOTs are being used in practice. Very much encourage you to make questions and comments during the webinar, but I will generally save up the questions until the end so that I can tackle them in batches if necessary. There will be a recording of the webinar made available both on our website and on our YouTube channel. And I should point out that if you would like to ask a question, you should have access to a question and answer box on your control panel, which you should have open in front of you. And if for some reason you can't make that facility work, don't hesitate to contact us by email or by phone, and we'd be very happy to deal with questions offline. So, what are we talking about when we discuss employee ownership trusts? We're talking about a new style, relatively new style of employee ownership trust, which was introduced in the Finance Act of 2014. It's therefore a statutory recognised trust. Obviously, employee benefit trusts have been in existence for many years as vehicles to hold shares in companies on behalf of employees. This is a special type of trust that was brought about as a result of the last coalition government's interest in employee ownership as a policy. In particular, it was the Lib Dem side of the last coalition government which was championing this particular piece of legislation. They wanted to stimulate the creation of what they called the John Lewis economy, named after the company which is probably the highest profile and certainly the largest employee-owned business in the UK. Much admired retailer that has been in existence as an employee-owned business since the 1920s. It's been through all sorts of economic cycles, booms and busts and recessions, and has continued its leadership position as a private, fully employee-owned business with now 86,000 partners or employees. And it's the success of that stable ownership structure at John Lewis which inspired the creation of the Employee Ownership Trust. And the idea was to encourage other business owners, like John Speed & Lewis, who was the founder of the John Lewis Partnership, to consider selling their business to an employee trust structure when they considered retirement or some other exit route. It was felt that this particular solution was not being given the consideration it deserved when advisors were helping business owners plan their succession. And so the thinking was to introduce two quite eye-catching tax reliefs that professional advisors would need to familiarize themselves with so that they were in a position to brief business owners about this particular type of exit route whenever that came on to the agenda. And the first of those eye-catching tax reliefs is an exemption from capital gains tax for business owners who sell a controlling interest in a trading company to an employee ownership trust. It's an exemption from capital gains tax without limit, and it is full exemption, unlike entrepreneurs relief, which, as you will know, carries a 10% rate of tax and is also subject to a lifetime limit of £10 million. This CGT relief is effectively 0% without limit. So it is very eye-catching. It stands out from the other forms of incentive for vendors to do certain things when they sell their business. The other tax relief, which is playing very much to the whole philosophy of employee ownership, is the availability of a tax relief for those companies that wish to use it. This is not mandatory, this is an optional feature. Tax relief on bonuses paid to employees of companies that are owned and controlled by an EOT. That's income tax relief, not employees' national insurance relief. And there is a limit of £3,600 of available tax relief on available bonuses per employee per year. And the key feature is that bonuses have to be paid, broadly speaking, to all employees on similar terms. In other words, broadly equitably. So that's the very interesting structure which was introduced just over 2 years ago. And in RM2, we're always keen to help the industry, the employee ownership movement, if you like, survey the landscape. And we share our know-how freely and widely. With this particular approach, we have conducted a survey which has been sponsored by the Trade Association for Employee Ownership. Many of you will know the Employee Ownership Association, and also by the John Lewis Partnership itself. They helped us set up an online survey tool which we have used to ask those EOT companies that we have identified how they are using them, why they're using them, and what lessons they would draw from using them. And then we're sharing that knowledge with the industry. So between us, the EOA and RM2 identify companies that have adopted this structure. It's almost certain that we have failed to identify all EOT companies, and that's simply because there is no requirement for companies to disclose the fact of their EOT to any public body. So we have to rely on press releases, we look at companies' house records, we look at what advisors are doing in this industry. We then approach those advisors and the companies themselves and ask them to complete a questionnaire. We supplement the results of that questionnaire with public domain information about the companies, in particular their trading performance, which we can obtain from Companies House. And we have chosen to exclude what are called grandfathered EOTs. I just need to explain what that term means. The legislation in 2014 allowed pre-existing employee benefit trusts that were structured in a certain way and which had behaved in a certain way, particularly in regard to their all-employee inclusive nature, to deem themselves to be EOTs. So this was a very helpful facility for those long-standing employee-owned businesses who would otherwise have been rather discriminated against with the EOT otherwise only being available to new adopters. We have chosen to exclude those grandfather companies because what we're really interested in surveying is how the new legislation has encouraged the adoption of new EOTs. We want to see, what behavioural impact it's having. And the survey website is there for anyone to use. There are also a number of other helpful bits of information on the website. For example, case studies of some recent EOT conversions. And we also show the results of the survey, which are calculated roughly every 6 months. We're not maintaining the real time. That's because there's quite a lot of quite complex analysis that we perform, but we will be refreshing the survey results every 6 months. And we are very grateful to both EOA and the John Lewis Partnership for their support for this project. project. So, first of all, let's look at which trade sectors EOTs are being established in. I think the good news is that EOTs are being found in a very broad range of industries. In other words, it's not something which is being confined to one narrow part of the economy. For example, it might be thought that only service-based companies would be eligible or find EOTs easy to adopt. But on the contrary, a good 29%, so almost a third of EOT companies are found in intensive manufacturing industries. Slightly more than a third, 37%, are in the sectors that you might expect them to fit quite naturally, namely professional, scientific, and technical activities. What we haven't shown in this presentation, but which I'd like to emphasize, is that the ownership of the companies which have moved into EOT structures have been almost all private, closely controlled companies. We've seen no PLC, broadly held PLC company move into the structure, and we have so far seen no private equity-backed company move into the structure. From the survey responses, we have only identified businesses that were owned privately by founders or by individuals, and where the EOT has been used as the succession solution for which it was always envisaged. If we look at the size of the EOT companies measured by employee numbers, 54% would be described as small businesses with fewer than 50 employees. But a good third are medium-sized businesses with between 51 and 200 employees. And there is a decent number of quite large enterprises. The largest, in fact, has 1,400 employees. And this is encouraging that we've not only seen a range of sectors adopt EOTs, but also a range of company size. Again, it's a proof that the structure is able to cope with both small and large transactions. The largest EOT company so far that we've identified has a turnover of 144 million pounds. And that size distribution, which we looked at by employee numbers, is rather reflected in the size distribution of turnover range. We've got a small number of companies, 7%, with a turnover of more than 50 million, 12% with a turnover of between 10 and 50 million. The smallest company has a turnover of just £150,000, so very small by any standards. And I think it's fair to say that as the EOT gets more and more established, we are seeing quite a number of SMEs adopt this structure in the knowledge that it can be done cost effectively and with good value for both vendors and the successor EOT. If we look at the level of shareholding which the EOT has taken in the company after the EOT is established, then as we would expect, nearly all cases the EOT has a majority of the company's share capital. And the reason we'd expect that is because it's only by having control that the EOT is able to offer capital gains tax relief to vendors and income tax relief on employee bonuses. There are, though, 10% of the survey respondents who had EOTs with less than 50%. That's still perfectly viable. It's a perfectly good employee trust structure which can be operated in a private company for the purposes of an internal share market, but only missing out on the two key tax reliefs if the EOT is less than 50%. Interestingly, of those not currently wholly owned by an EOT, over half said they had definite plans to increase their holding towards 100%. And that, I guess, is the epitome of a stable ownership structure, when the entire issued share capital is owned by a trust. That's the John Lewis structure. But it should be emphasized that EOTs coexist perfectly happily with minority shareholdings. And a very common permutation that we've seen in our RM2 projects is a situation where an EOT owns a majority of the share capital, and other shareholders, whether that's vendors or founders rather, all management shareholders have owned the minority. That's a perfectly viable and sustainable structure. We've also seen arrangements where employee shareholders, employees in their own name, have become direct shareholders alongside a controlling EOT. We asked our EOT companies, why did they set up the EOT? What was their motivation? And we asked, encouraged them to make multiple responses. So this is the sum of sometimes more than one answer. The most common answer, this was a free text answer, so we've synthesized that free text into these categories, was around improving employee engagement as a fundamental reason for introducing the EOT, which I think is what the policymakers who introduced the EOT originally would have expected. This is a succession tool to help business owners pass the company on to employees, but with the very strong business objective of making sure employees are fully involved in the business, both from the point of view of motivation and in terms of share of wealth. Just over a quarter, described their main objective as being succession planning. Just under a quarter, 23%, said that they were very keen to keep their business independent. And then we had some other more general answers around just improving the business. Only a minority, a small minority, emphasised the tax aspect. So I guess helpfully the tax tail is not wagging the employee ownership dog. Here's just a selection of the free text answers that people gave to that previous question about motivation. So improved performance and the ability to share rewards and benefits, as well as clear succession planning and a controlled exit for the founders. I'll let you read that slide yourselves. But the important point here is that an EOT can suit multiple objectives. It's a win-win out for business owners looking to exit, for employees looking for assurance about independence and a sharing wealth, and for successor management who can be certain that they are leading a business which has been left in good, stable hands thanks to a friendly, negotiated transaction with the previous owners. Some of whom, of course, may still be involved in the business. There's no requirement here for vendors to leave the management of a business. They can stay involved and often are involved, so providing that sort of very welcome continuity. Now, the tax reliefs are the reason for the EOT. There would be little point in legislating for a new type of employee trust if it weren't for these two tax reliefs. And so we asked the question, was the EOT acquisition structured with the aim of allowing one or more vendors to claim the capital gains tax relief? Over half, in fact over 60%, said that the CGT relief was a factor in deciding on the EOT structure. But actually a larger proportion, 86%, said they were doing it to take advantage of the ability to pay income tax-free bonuses. I think the important feedback for the policymakers here is that the tax reliefs have been instrumental. They were worth introducing. They have had the effect of motivating people to go down this path, which was always the objective. We then wanted to try and unpack the relative importance of those two tax reliefs, see which one was the clincher in the majority of cases. 62% of respondents said that both the tax reliefs were equally important. 24% said really it was only the facility to pay tax-free bonuses that motivated them. 14% said tax reliefs had no bearing at all on their decision, and no one said that they were motivated solely by the CGT relief. So in other words, the vendor benefit here is not something which alone has been instrumental. Again, I think that's a really helpful piece of feedback for policymakers. It was a really smart move for them to come up with an arrangement which benefited both the current owners of businesses and the new beneficial owners of businesses through the tax-free bonuses. There's a really nice symmetry there, which is obviously being appreciated and played out in practice in the market. We asked, were companies committed to employee ownership before the tax reliefs were announced? In other words, what we're trying to get at here is whether the early adopters of the EOT, the ones who've answered our survey, were always likely to go down this path anyway. Well, interestingly enough, because it is still early days, we're still only just 2 years into this structure, 3/4 said yes, they were already committed to this idea before the tax reliefs were announced. So I think what we're seeing here in this first set of survey results is the early adopters being mainly existing enthusiasts of employee ownership, which I think is what you would expect. There was sort of pent-up interest from some business owners who've been studying the subject, and it was the Finance Act of 2014 which pushed them across the finish line to get to the structure they wanted. But as time goes on, and we'll repeat this exercise in the next 6 months or the next 12 months, we expect to see more and more companies who previously had not even heard of employee ownership being encouraged to look at it thanks to the new structure. So we'll keep an eye on this answer and see how it changes over time. We were keen to see how people had originally come across the EOT because, as is so often the case, legislation gets passed in the small print of a budget or small print of a Finance Act, but the government invests little or no time in actually publicising that fact. It's left to the industry, the users of the legislation, to bang the drum. And as one might expect, 41% of respondents had heard about the EOT from their professional advisor, their retained advisor. Encouragingly for EOA, the trade association, 27% heard about it first from the EOA, so they're fulfilling their promotional role. And then 18% heard from another employee-owned company, usually one in their trade sector. We find in our work that these projects tend to go viral within a particular trade sector. That a business owner will do something quite novel and quite pioneering, and then competitors in that sector will take notice and can very often follow. One sector at the moment which is extremely active is what I would call the professional services around the built environment. So architects, structural engineers, civil engineers, and all sorts of businesses connected with construction and building presently seem to be very enthusiastic adopters of EOTs. Where did the EOT get its shares from? Well, in 57% of cases it came from the original owners of the business, proving the point that this is very much presented as a succession tool for existing business owners. 35% came from existing shareholders who were not founders, so if you like, second generation businesses, perhaps ones that have become management owned after the founders had exited. And 4% got their shares from an EOT, sorry, I beg your pardon, an EBT, an existing employee benefit trust. There's no reason why an EOT can't subscribe for new issue shares, and indeed 4% of our respondents sourced their shares from new issue. How much did the EOT pay for its shares? The purpose of this question is to tease out whether EOTs are being done on fully commercial terms or whether they're being done on somewhat philanthropic terms as a result of the goodwill of the owner. Well, interestingly, 2/3, 65% of transactions are being done at what the owners and the trustees consider to be fair market value. We consider that to be rather good news. It means that this is a commercial structure which does not rely upon the generosity of a business owner for it to take root. Of course, we always applaud and praise business owners who have the foresight and the generosity to make gifts, settlements of shares to employees. That has happened over the years, and it's great to see. But whilst ever we're relying entirely on those sorts of gestures, we're not going to see employee ownership established in the mainstream of the economy. So it's great to see that as many as 2/3 of the EOTs have found a way to pay what the vendors have regarded as fair market value. There is still some generosity on display. 15% of transactions were done at what was regarded as a discount to fair market value of at least 25%. And 10% of cases did involve a gift, which is always very pleasing to see. In cases where the transaction didn't involve a gift, which as we've just seen is the vast majority, how was the EOT able to purchase its shares? Well, in the majority, or rather in the most common case, 44%, the vendors have effectively allowed the EOT to buy their shares on partly deferred terms. In other words, a vendor loan. 16% so far have raised external bank finance, and that's a market which in RM2 we are developing very actively so that we can help large businesses with succession and provide liquidity up front to selling shareholders. 4% have obtained finance from a specialist source. 4% by way of a loan from the company, which assumes the company already had the means to make that loan. 24% by way of a gift. Again, that assumes the company already has free cash on the balance sheet to make that gift. Of the 80% which involved some payment to the vendor, almost half were provided by a vendor loan note. In other words, a clearly documented loan agreement in which repayments, interest terms were clearly set out, which in our business in RM2 we argue is a very good thing to have. We think it's in the interests of the trust and in the interest of the vendor for vendor repayment terms to be very clearly agreed and documented. And ideally we think they should be done on commercial terms, because that makes it possible for the EOT in future, if it wishes, to consider refinancing that vendor loan from an external commercial source, such as a bank, which may have the effect of improving the terms on which the EOT is borrowing, and it certainly has the effect of giving the vendor further liquidity if that's required. You'll see there that 71% have obtained what's called a Section 701 tax clearance. Now, the reason that is so common is because it's a way of getting assurance in advance from HMRC that the disposal of shares by the vendor to the EOT is going to be treated as a capital disposal. In other words, subject to the capital gains tax regime and therefore exempt from capital gains tax if the EOT rules are satisfied. And that's important assurance to obtain where company money is in some way involved in financing that purchase of shares, as we have seen from this pie chart, is sometimes the case. Moving on quickly to the trustees. EOT trustees were drawn more or less equally from three categories. First of all, a company director, giving, if you like, a board representation on the EOT trust body. Secondly, an employee chosen from outside the boardroom and in a position to represent the interests of employees generally. And third most common would be an external professional trustee, an independent person who can bring a fresh and objective perspective. We found that 3 is the most common number, but the legislation is completely silent on the identity of the EOT trustees. Companies are free to select the arrangements that suit them best and suit their culture best. That leaves open a lot of flexibility in design, so that the corporate governance structure of the company builds on existing practices and works with the grain of how companies like to operate. Legislation is also silent on the domicile of the trust, and it's therefore possible for an EOT trustee to be located offshore, although we have seen that so far in only one of the survey responses. The reason it might be considered is a very straightforward commercial reason, which is that there is a risk that the tax relief given originally to vendors might be clawed back if certain terms of the EOT trust structure are deliberately or accidentally breached. And the most likely breach is going to be where the EOT shareholding drops below 50%. That might arise, for example, if the company needs to raise new capital and issue new equity, or it might arise if the company decides, for good or bad reasons, to sell itself to a third party. In both those scenarios, the capital gains tax relief given to the vendor originally is going to fall to the EOT to be paid. And for that reason, in one case so far, and in other cases that we're aware of, some companies are considering locating their EOT trustee offshore. Having said that, we're aware of arrangements where the offshore trust providers are perfectly willing to entertain co-trusteeship by employees and to follow expressions of wishes from the company, so that arrangements are very much sort of friendly, but still, of course, professionally conducted. And then finally, the all-important question to EOT adopters: would you recommend others do it? And you rarely see a net promoter score as high as this, but 95% of the companies that we surveyed said it's a business model they would recommend to others, and it's an important part of their future plans. The other 5% simply said it's too early to say. So a very positive endorsement, and we ourselves are finding this to be an extremely versatile tool, and one that we would encourage all business owners to seriously consider when they come to plan their exit route. In fact, where before a management buyout might have been contemplated, business owners should definitely consider an EOT as a viable alternative. Let me just now just see if we have any questions, which involves me doing a little bit of footwork on the... Here's one question: does the price paid by the EOT for its shares have to be approved by anyone, for example, HMRC? Because you remember I said that in a majority of cases, I think it was 65% of cases, vendors are obtaining fair market value. That's a good question. There is no requirement in the legislation for a value to be approved, and indeed there's no facility on offer from HMRC for a value to be approved. We do think, as a matter of good practice, that trustees ought to be independently advised that the value that they're paying is no more than fair market value. And in our projects, we always arrange a completely independent firm, often one, in fact, chosen by the company, to express and commit a valuation opinion to the trustees for that assurance. That's not only a matter of fiduciary duty and good practice, but also arguably the trustees would be in breach of their trust deed if they were to pay more than market value. Now, because these are friendly transactions between known purchasers and known fellas, we think perhaps there's an even greater sort of requirement to get that sort of health check of an independent valuation opinion. But the legislation does not absolutely require it. Another question here. In your experience, does employee ownership actually create real changes in a company? Another very good question. I would say that eventually, not always immediately, a change to employee ownership does result in a different kind of business, a business which takes a different approach to long-term, a different approach to the way it involves and engages its people, a different approach to the way employees are generally considered and involved in all the formal structures of the company. But I think my word there was eventually. I think it takes quite a long time for companies to adjust to a previous regime of founder ownership where the founder's personality and possibly know-how was very much stamped all over the company, to one in which companies now run for the long-term benefit of its employees. We don't see overnight change, and in fact we caution against changing too much too quickly. But there's a certain inevitable, inescapable logic to the fact that once a business is employee-owned, its behavior, the way it runs, the people to whom ultimately it's accountable for its actions does change. There is help out there from some excellent change management consultants who can often handhold and guide a business through these cultural changes. RM2's role has historically been very much at the point of ownership change, but we're very much keen to make sure that our clients are left in very good hands. And we ourselves provide a trustee support service to make sure that we're always on call to answer questions about how companies should change and adapt. I've got one more question and then we ought to finish. How do I motivate and retain key employees if I implement an EOT? That's a good question, because remember, a key feature of an EOT is that it has to operate for the benefit of all employees on similar terms. It's not possible to allocate ownership from the EOT disproportionately to selected individuals, nor is that usually going to happen anyway. An EOT is generally going to sit on its shareholding for the long term. So that begs the question, what's in it for people who might otherwise have been hoping to execute a management buyout? Well, it's perfectly possible, and indeed now very common, for minority shareholdings to be made available to key employees to make sure that they are fully engaged and committed and motivated to stay with the company. It's also possible, uniquely with an EOT structure, to operate tax-advantaged share schemes such as EMI and CSOP, Company Share Option Plan. Those two tax advantage schemes, which are commonly used in private companies, can't normally operate in a company controlled by another company. And EOT companies are usually controlled by another company. That's the trust company on which the trustees serve and ultimately control the underlying trading company. But there is a specific exemption for EMI plans and CSOP plans in the case of companies controlled by an EOT. So increasingly we're seeing arrangements where the all-employee EOT is co-owning a business alongside minority shareholdings from key employees or share option schemes for key employees. But of course, it doesn't have to involve share ownership. It's perfectly possible, and arguably sometimes a little bit more simple, to operate a cash-based scheme for key employees, whether they're senior management or just very scarce talent. So we've not, in any case that we've been involved in, yet seen any difficulty or challenge in making sure that the right balance of reward has been achieved. We're to finish now because we're out of time. I just wanted to thank everyone for participating. We're going to send you a little email soon to ask for your feedback on this webinar so that we can always improve them. We're doing them at the moment roughly every 2 weeks, and we're keen to build on your feedback and make them better and better. So please do just take a couple of minutes to give us that feedback. If you've got any follow-up questions that we've not been able to answer, please do not hesitate to contact me. The email address was on the front slide. It's nigel.mason@rm2.co.uk, or phone the main RM2 office number 020-8949-5522. Thank you very much for your participation, and we hope to see you very soon.